Good morning, this is Ken Long from Tortoise Capital with the review of the weekend trading report for August 31st, 2014. The market has pulled back into bullish quiet mode, which is good long term. On an annual basis, using weekly RSI 14, we are at the higher end of neutral at 69 out of 100. 70 is the threshold to move into overbought on long term. So we've seen a return of relative strength to the market. On a shorter term basis, using the 10-day NDX, we're at overbought conditions at 97 out of 100. Looking at the market mosaic, we have price relative to the 200-day moving average in yellow, bullish at 7.35%, so a little over 5.25% cushion to sideways markets. Slope of the 50 is yellow neutral. ADX has improved to 22.6. The bulls are in charge, but not trending strongly yet. ATR percentage down to a microscopic 0.58%. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold is 1.0 between risk on and risk off. The current reading is at 1.13, which is risk on. Riskier assets are favored. If we take the score of 1.13, compare that to the last 5,000 trading days, and find the standard deviation, we end up with the risk Z score of positive 1.46. That's 1.46 standard deviations above the 5,000 day average. You can see the 90-day time series of that indicator here. We had a 2 sigma adverse move of volatility. When that reversed, this set up the really nice XIV intraday and swing trades, which we've enjoyed here, about a 15% gain in the last 10 days or so. We're now at a positive 1.5 risk Z and starting to roll over. That suggests this is more like the end of that exceptional run back to what was previously fair value, pushing all-time highs. So there's never easy money, but the easier money feels like it's done, and now we're back to potential grinding bull quiet. Monthly rebalancing this week. You can see the last month's holdings. The current holdings are recommended here for the different ETF portfolio populations. No change in ETF 13. In ETF 22, it trades emerging markets for Latin America. And in ETF 32, it trades the emerging small caps for Latin America. And then you can see the leaders in the other populations here. In ETF 2, the theoretical exposure is at 80%, and the model portfolio is at 80%. Just a quick look at the winners and losers in the different ETF portfolios for blended monthly. You can see only EFA, the globals, are on a cash position. That's priced relative to the 4-month moving average. You can see the difference in gains between the leaders in Latin America and the laggards in the Euro-Asia globals. ETF 32, again, Brazil, Latin America at the top. That's where the relative strength is. And then it's emerging Europe, European 350, agriculture and commodities suffering down here below their 4-month. And again, you can see almost a 22% difference in performance over the last 3 months. That suggests that there is reason to look for sector performances to find the variance in performance. ETF Max, this is looking at about 1,300 different ETFs. I like looking for the things that are green and then white. So biotech is green and white. Gold Explorers, green and yellow. Global Carbon, green and red. I mean, that's a 42% difference between the 6-month and the 3-month, so there may be something interesting and volatile in carbon as a focused volatility play. It bears more investigation. Weakness creeping into India now, and the India Nifty 50. Strength in the biotechs again, so that seems to be the rotational leaders. This is just a quick look at the S&P 500, the top 40 or so out of the S&P 500 to include the sector that they are a member of. U.S. Steel remaining strong and an interesting swing play. Green and white, again, we're looking at International Gaming, Monster Beverage, Vertex Pharmaceuticals, PetSmart and Celgene, and the XLV, XLY space. Looking at the market health check here, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance levels. Now we've been able to close and stay above this previous swing high for 5 days and resuming with 2 days of strength to close the weekend, or close the week last week, and combined with bull quiet, that's a very strong vote of confidence. You can just see the difference in the daily ranges expressed here versus the panic selling on the ways down. These are frog candidate days when you get this kind of collapse. That's the best days for frogs, those great big signal days with large relative ranges. Now we're back more into the grinding bull here. You can see the 30-period regression line slope reflected in this sine wave. You can see where it crossed the zero line and went negative here, bottomed out at about minus 0.19, which is very near an exceptionally steep move down, found support, and then this was that move here. When it reverses, that's usually an interesting moment when it gets to an extreme steep. That reinforced this Z trade pattern here, and crossing the dragon at the edge of the river was the indicator, and gives us this move here. And that's a nice move in the S&P, a very nice move in XIV as well. The jaws of PPO remain open, although it's stalling a little bit as the market was reaching new highs and the volatility kind of dried up a little. You can see we've still got that 5.5% cushion between sideways market and this 200-period moving average. The bulls are back in charge in ADX, although the ADX indicator itself at 22 is still non-trending. We've been overbought for about 12 days. It can stay that way for long periods of time. And then the last time it did that, the pullback was slight and still allowed a nice grinding move of about $10. So 210 on the upside is not out of reach here in the S&P. Looking at the ETF2 regional report, 8 of the sectors out of 10 are on buy signals, 2 on cash, so it keeps us at 80-20. The S&P at 72 is still better than globals at 66. Inside the U.S., it's tech at 77, large cap 72, mid cap 71, and small cap 69. 2 strongest sectors, technology in Latin America, followed by emerging markets. 2 weakest sectors, Japan at 69 and the globals at 66. Everything in the U.S. large caps, green and good to go. Strength in healthcare, especially technology, and then energy. World market model, only the small caps are below average in the U.S. Technology still leading the way. Everything Western Hemisphere, Latin America, emerging markets, Canada, Mexico, Brazil, well above average. That's the relative strength there. Japan below average, Asia lists Japan above average, China, Taiwan, India, Thailand, and Vietnam leading the way, only Malaysia lagging. Everything Europe, notice is weak. Treasuries and U.S. real estate above average, but every one of the other asset classes below average or significantly below, which leads us to start thinking about looking for value plays there in the commodity space. The U.S. business sectors generally a step ahead of their global counterparts, so it's all U.S. all the time right now. ETF top 30 using the ETF2 database lens. I look for green and white. So Brazil, Latin America, especially Latin America, looking solid here. MLP infrastructure, energy, the BRICS, more MLPs, and you can see the strength. Otherwise, in this solid block here, in India remains strong, but my sense is we're starting to rotate away from India. The Dow 30, Intel, Home Depot, Home Depot, Microsoft, United Health, and Caterpillar have the current strength. Intel and Microsoft just dominating in the tech space. That's the place to continue to reward outperformance intraday and build that into swing trades. White and then yellow, the next round coming up. IBM, Procter & Gamble, AT&T. Red and yellow, these are the laggards. That's DuPont, Boeing, McDonald's, United Tech, still at the bottom of the stack, not benefiting from the tech surgence. Caterpillar, United Health, still interesting here is the green and white. Home Depot, again, green and white is one of my short list go-tos on the intraday and swing trade frames. ETF liquidity, just for your statistical information. Green is very volatile and very liquid, so the VIX, Brazil, and gold monitor. Brazil right now is really a tradable entity at almost about 3 times more volatile than the S&P, and terrific volume. Shifting to the daily report, we got a channeling signal in Asia less Japan, channeling an overreaction in Japan, auto framer firing on gold and VIX, but little else. The 10-day min pain, these are the relative strength leaders: Caterpillar, Home Depot, Cisco, AT&T, and Verizon. 10-day max pain, these are the largest percentage pullback from their 10-day high: Visa, United Tech, Nike, Bank of America, GE. Only a couple dojis to choose from. Nothing fires on the Dow Tactical. You can see the winners and losers from Friday indicating in red. Big strength here in Home Depot. Just notice that it's closed at new highs over the 10-day, 1 month, and 3 month. Strength in Caterpillar at 104 and 102. Big move up in Chevron on a 10-day NDX at 117, and especially so in Verizon at 126. So we'll take a look at those symbols. ETF tactical, Japan fires channeling an overreaction, a handful of dojis. Japan also firing on the RSI2, only one frog number better than 3, and that's in blended commodities. Again, great big winners here in Latin America and Brazil. That's where our attention should be to continue to milk that cow. Here's some auto framer and regression line fractal frameworks. These are showing the risk rewards are calibrated in terms of the ATR of each one of these symbols. The ones in green in this top stack are the ones that are the most below their own 270 regression line, which we take as a long-term fair value. So that's the longest way back up. So McDonald's is almost 6 ATRs below its 270 regression line. And conversely, these in the red, these are how far ahead of their regression line 270 they are. FDO, we've highlighted that one for a couple of weeks, is almost 20 ATR above its 270 regression line. And so that continues to reward attention. In the market mosaic, you can see that the polynomial regression line has rolled and crossed and still pointing up. The jaws are open. Pushing above 201 would be a very favorable sign. You can see how the crossover here of the 30-period regression line slope and its 10-day moving average. There was a crossover here outside of the plus or minus 1 SD. And so that gives us an alert in this region for a change in direction. We're back to just above the 6-month period moving average, or the 6-month average for the regression line slope. That means this is just back to normal bullish tendencies that we've had for the last year or 6 months or so. So in good shape. We pulled back to a 6-month average lead over the 200 period moving average after that 2 sigma adverse move. A natural place to pause and reflect for additional gains. Absent news, I think the trend continues, and it's the U.S. all the time. See just how the volatility has collapsed after that last, what was only 4 to 5% pullback, and we're back into quiet conditions again. That's everything I want to look at for the weekend report, and I'll do a separate recording for members for trade frames going into the week ahead, looking at some of those key charts. So this is Ken Long from Tortoise Capital. Thanks for your attention. Good trading.